You are listening to the CMQ Investing Podcast. My name is Chris Franco, and I want to talk to you about the most important thing that no one really talks about. Something that actually, if you listen to this, follow the advice, you're almost guaranteed to make more money than if you don't follow the advice. And that's not investment advice, that's a mathematical fact. And what I'm talking about is the costs of investing. Investors for many years have been incurring very large fees and transactional costs by investing with the help of what Warren Buffett might describe as helpers, or Jack Bogle would simply point out as the investment business. Now, what I mean is if you look at something like an ETF that you invest in, there is an expense ratio associated with it. That is a cost you are incurring that takes away from whatever the gains that brings you. For example, a Cathie Wood actively managed ETF brings you or costs you 0.75%. And that's just on the front end costs. I don't know what the back end costs would be. You know, if there's different transactional costs or how sometimes they can incur taxes. But let's not speak about a particular fund. Let's talk about the reality here. So the average investor, from the latest data, and this comes from Dalbert, tends to lag the market rate of return by anywhere between 3 and 4 percentage points. Now, over a short period of time, that's a meaningful amount of money. But over a long period of time, you're talking about a devastating amount of money. I'll give you an example. If two investors invest, one does it by themselves, one does it with the help of, maybe an investment management company or the investment business. Let's say one gets 7% and the other, who has costs and fees, gets 5%, less those costs and fees. Over a 50-year period, that investor who paid the fees and the costs and the transactionals, everything else, gave up about 2/3 of the value that they would have otherwise had. And that's again, mathematical fact. And I will provide the data for you in this episode. So, I'm not just throwing out big, bold statements. Everything here is backed up and it agrees with reality. Now, the question you might be asking is, well, why haven't I heard of this before? Or why are not more people talking about this? If you go back to the very first episode that I ever did for the CMQ Investing Podcast, or even the very first quote that I posted to Charlie Munger Quotes, which is now over 2 years ago, it's about how incentives are superpowers. Show me the incentives and I'll show you the outcomes. There are not many people who have the incentive to tell us to watch our costs. They just don't. Why would they? Jack Bogle was so unique, and the reason I want to talk about this at length in this episode is because Jack Bogle is no longer living. And while his legacy is undoubtedly living on, you don't have Jack Bogle, spreading the gospel of low-cost investing. And low-cost investing itself very much aligns with what, CMQ is all about in terms of highlighting the importance of compounding as a wealth builder. There is a compounding cost that comes from costs. Those costs add up and they compound just as much as your returns do. So by minimizing them, by optimizing them, you put yourself in a much better position to make a lot more money. And another reason why I think this is so critical is as we enter, and we are in much more of a choppy market than we have been since we first started doing the podcast together, you have to figure out, okay, what can I control and what can I not control? Now, you can't control the macroeconomic stuff. You can't control, what a business is going to do. But what you can control is, how you respond to macroeconomic news, or, how you take a company's earnings report, whether or not you overreact, or, you keep your long perspective in mind. Now, something you can control and absolutely have full control over is the cost of investing. And that's just what this is about, because you can today make changes to your portfolio or the way that you invest that is going to absolutely make a massive difference to what you end up with, given you have a long perspective, or a long time horizon, I should say. And as I said, this is it's mathematically inarguable. You cannot argue with the math, and it's not complicated math. Just take someone who has $100,000, invest that at a 7% rate of return for 50 years. Then take some person who's got $100,000 who invests that at a 5% rate of return for 50 years. That person who does 5% gives up 2/3 of the value that they would have otherwise had they not been paying an approximate, let's say, 2% worth of costs and fees. Now, and by the way, that's a fairly conservative estimate, because you might see, if you work with an investment manager, they're charging you a wrap fee. But then you also have to look at what they have you in. And what I found from my own experience is my money was being put into funds that had high expense ratios. And that's added to the cost as well. There's many more factors at play here, but let me read you a quick section here from Jack Bogle's classic book, The Little Book of Common Sense Investing. By the way, Warren Buffett is quoted in here. I think even Charlie Munger is. all of my favorite investors, they all sort of have like they end up kind of mirroring each other in different places. I end up, if I'm reading something about, Warren Buffett, I'll see something about Jack Bogle and vice versa. And I think that's a good sign. This is, if anyone has this book, if you're interested, it's on page 45, and it goes like this. Investors pay far too little attention to the costs of investing. It's especially easy to underrate their importance under today's three conditions. When stock market returns have been high, when investors focus on short-term returns, ignoring the truly confiscatory, I sound really smart, impact of costs over an investment lifetime, and 3, when so many costs are hidden from view. And he mentions here portfolio transaction costs, the largely unrecognized impact of front-end sales charges, and taxes incurred on fund distributions from capital gains, often realized unnecessarily. Perhaps an example will help, and everybody pay close attention to this because it almost doesn't seem real. Let's assume that the stock market generates a total return averaging 7% per year over a half century. Yes, that may seem a long time, but an investment lifetime is now actually even longer than that. 65 or 70 years for an investor who goes to work at age 22, begins to invest immediately, and works until, say, age 65, and then continues to invest over an actuarial life expectancy of 20 or more years thereafter. Now, personally, guys, I plan to live forever. So I don't really have an end. There's no end to my timeline. That's actually Connor, the overconfident investor. If you guys are listeners of the podcast, Connor is going to make a return soon, so stay tuned for that. Now, let's assume that the average mutual fund operated at a cost of at least an assumed 2% per year. The result? A net annual return of just 5% for the average fund. Based on these assumptions, let's look at the returns earned on $10,000 over 50 years. Assuming a nominal annual return of 7%, the simple investment in the stock market grows to $294,000, about $295,000. Why? It's because the magic of compounding returns over an investment lifetime. In the early years, the line, and there's a graph here, but he says the line showing the growth at 5% annual rate doesn't look all that different from the growth in the stock market itself. And, since you can't see this graph, what we know about compounding is it really starts to take off. That snowball starts to get really big with more time. So that's what he's just describing here about this data visual. But Jack Bogle continues, but ever so slowly, the lines begin to diverge, finally resulting in a truly dramatic gap. By the end of the 50-year period, the value accumulated in the fund totals just $115,000, an astounding shortfall of nearly $180,000 to the cumulative return earned in the market itself. Why? The tyranny of compounding costs over that lifetime. In the investment field, time doesn't heal all wounds. It makes them worse. That is a heck of a quote. In the investment field, time doesn't heal all wounds. It makes them worse. Where returns are concerned, time is your friend. But where costs are concerned, time is your enemy. This point is powerfully illustrated when we consider how much of the value of the $10,000 investment is eroded with each passing year. Now here's the last part. By the end of the first year, only about 2% of the potential value of your capital has vanished. By the 10th year, 17% has vanished. By the 30th year, 43% has vanished. And by the end of the 50-year investment period, costs have consumed 61% of the potential accumulation available simply by holding the market portfolio, leaving only 39% for the investor. Now, this next quote should be printed on everybody's, you should print it and put it on a wall in your office just to remind yourself of this. You put up 100% of the capital and you assume 100% of the risk, but you earn less than 40% of the potential return. That should just be, to me, hearing something like that makes me embarrassed to think that I might be paying unnecessarily or paying fees that are unnecessarily high. And the way that I combat this in my own investments is the ETF that I buy the most of and have historically bought the most of is the VU. Now, it has an expense ratio, but the expense ratio is 0.03%. 0.03%. And you might say, well, why not get something with zero expense? Well, the reason is because companies do have to make money, and it's not completely free to have an index fund that you can offer to people. Like there is a cost to create that product and make it available. The key is, though, you're making sure that the profit that is being made on those products is not, at your expense. And the VU is, in my opinion, the best in the business as far as low cost and from a company that I find has always represented something quality. Now, someone just jumped up and said the QQQ. I'm not a fan of the QQQ, and I know that's a controversial thing to say because people seem to have made the QQQ into like the new VU. If you're going to do a low cost index fund, you want broad diversification. That's what you're after, and the QQQ doesn't really offer that. It's 100 different companies, very much concentrated in information technology. And the other thing to keep in mind with the QQQ, I won't even go into the expense ratio. Invesco increased their marketing budget pretty substantially over the last couple of years to capitalize on the interest in it. And one of the reasons there's been an interest in it is the same reason that there's been an interest in plenty of funds that have disappointed in long-term investors. It's based on recent past returns. One of the biggest mistakes investors make, historically speaking, is chasing a past return. Chasing because that's what they advertise, right? How is this done, in the last 3, 5, or 10 years? But people tend to pay more attention to the short term, thinking that, hey, this thing's like, the momentum's there, I'm going to hop on and ride it up. Reversion to the mean is real. And something like, I also want to factor in with the VU is it's inception time. Well, it's been around longer. It's more, nothing's guaranteed, but it's something that I feel like has a much more, it's got a much greater chance of, I think, delivering the market rate of return, which is what I'm after. I'm not trying to get a return that's of the top 100, like NASDAQ companies excluding financials. The VU gives me exposure to the success of the 500 largest US-based companies, obviously weighted by market cap. But that's my quick take on the QQQ, and I do plan to make some content about like the VU versus the QQQ, because I see this on Reddit all the time. People always ask this question, and people will say, "Oh, invest in both." I just think that's kind of nonsensical. Whatever you do, it doesn't have to be any of the VU. It doesn't have to be the QQQ. I'm not making the recommendation for you, but what I will recommend, and I think it's a no-brainer, is keep your costs as low as humanly possible. You are losing an enormous amount of money if you are a long-term investor and paying costs. Those costs, in many cases, are just there to delete value from you and put money in the pockets of the investment management business. I'm not against anyone making money, but I don't like money that's made for really adding no value. And that's how I would look at if someone's charging you a wrap fee and has you loaded up on index funds. What exactly are they doing for you? What exactly would you describe the value being added? How would you describe that? Nobody has rights to the market rate of return. No one has rights to the returns of the market. Like that's the market. No one owns that, right? As an investor, your goal is to try to capture as much of that as humanly possible. And as history shows us, if you just do the average market rate of return over a 30, 40, 50 year period of time, that's a heck of a way to make money because you literally have to do nothing. It's the most sensible way for just pretty much all investors. If you look at the statistics, there is very few examples of anyone being able to pick stocks and outperform the market doing that over a 10-year period of time. And as you get to like a 20-year period of time, it's practically non-existent. We'll get into the reasons why that is, but I like to go off evidence. I'm not going off emotion here, and I like to do things that give me the most reliable chance of making my money make more money. And if we're compounding, the money that money makes money, and the money that money makes money. Did I say that right? Probably not. What is it? Money makes money, and the money that money makes money. That's compounding, put simply in a way that could be turned into some sort of hip hop song. But anyway, that's my take on this. If you have any questions, I'm happy to answer. I appreciate you guys for listening. And at the end of the day, someone just quoted this. They said, "I hate money charged that doesn't add any value." CMQ. I'm glad I'm dropping quotables for you. It's just important. And remember, no one has any incentive to tell you this. Everywhere you look, they're trying to get you to do something because the more you move, the more you lose. I think every investor should have to go down to Wall Street and see how it's really done because you'll realize you don't have a shot. It's humbling, especially in a market that's not going to be as maybe easy as the last couple of years were. You're dealing with professionals who are doing this nonstop and trying to predict future cash flows. That's the market. Right? You're not going to beat the market. The best bet is to just put your money in the market and sit back and capture as much of the returns as you can, and those costs and fees and everything else take away from that. So I hope that message is clear. I hope you understand it. I hope it's helpful to you. It's not debatable. No one can say it, but it's true. No one can have an argument to this. and I'd say, what's up, Colt? Colt had just said by the way, we have a CMQ investing community here. So I'm on IG Live right now if you're listening through the podcast. And Colt just went to work at Fidelity. So congrats on the job. One thing I say with Fidelity, and I have a Fidelity brokerage account. That's not an endorsement, by the way. I just do. But Fidelity does have lower expense ratios, but they're typically there because they're loss leaders. In my opinion, for investing in something like the VU, if that's something you choose to do after you do your research, I prefer to do it straight up through Vanguard. And I also find with Vanguard's interface, it doesn't really motivate me to do anything else, which is good because I was talking to someone today about this. If you had to look at your portfolio, but before you do, you have to walk through the first floor of a casino, it's very tempting, or it's very hard not to walk up to at least every now and then one slot machine and just pull on the lever. And I find when I use different accounts, there's much more news about what's going on with certain stocks. There's a lot more red and green. That tends to just motivate me to, and they also make it really easy, to do things that typically don't work out for long-term investors. So that's not a jab at any one institution. I'm just telling you my perspective. And I think if let's say I could buy a product from the person that makes it or from somebody else, I prefer to buy it straight from the person that makes it. And that's why I do things like the VU through Vanguard directly. I have no incentive to say any of this. I have no affiliate relationships. I'm just telling you my opinion here and my honest opinion. So anyway, that's the take right now. I appreciate you as always for listening. Please follow and subscribe to the podcast if you have not already. That is a great way to make sure you get all these updates when new content drops. And I really appreciate you guys. So for CMQ Investing, my name is Chris Franco, and we will talk soon. Later.